Friday, October 11th, 2024, Maneco 64, home of alternative economics and contrarian views. So Clive and I are back. Last week, of course, I was in Rome. So, Clive, how are you?
Well, doing great, Mario. You went to see the Vatican, I saw.
Yeah, we went to the Vatican museums. I mean, it's only one museum, but the tour guide was telling us that there's different rooms in the museum. That's why they call it the museums. There's a lot of art there, and it's nothing to do with religion, the art. It's all about art. Because I think a lot of the popes in the Middle Ages, they liked buying all the art. I guess they had quite a bit of money back then. And then we went into the Sistine Chapel, which was interesting but very crowded. And then St. Peter's Cathedral, all in the same day. And we did a lot of other things. And the good thing about Rome is you walk a lot. It's much better than taking a cab. So we had a good time. But now we're back to the markets and what's happening. And we were chatting before starting here that you think there's a second wave of inflation coming and that the bond markets are pointing to that. So maybe we can start with that.
Well, I mean, first of all, the super core inflation in America, it's over 4% and not falling. The target of 2% still seems out of reach. And I don't think inflation, the headline inflation, which is 2.6, is going to fall anymore either. So I think Jerome Powell has started cutting rates just in time. Because, I don't think next month's figures are necessarily going to do him any favors. But what actually tells me inflation is probably around the corner is what the bond vigilantes are saying. And if I could just share a little slide here, Mario, just go to the right page first. I'm just going to.
And the bond vigilantes, for those of you who don't know, they were big in the 70s and 80s and even early 90s. But ever since the early 90s, they've been basically in hibernation because bond markets have behaved. But it's something that one of Bill Clinton's advisors said that if he was born again, he'd want to be born as the bond market so he could boss everyone around.
Well, what you're looking at, I think you can see it, Mario. Can you, the chart?
Yeah.
Interest rates, this is the interest rates since the date they cut the interest rates on September the 18th by 0.5%. But this is the interest rate on the 10-year bond. And although short-term rates were cut by 0.5%, long-term rates, so this isn't really a long-term rate, it's the 10-year rate, have risen by 0.5%. We've gone from a low of 3.59% on that day through to 4.12%. That's just over 0.5% rise in the 10-year interest rate. And it's not just the 10-year. If you look at the 5-year or the 20-year or the 30-year bond, you'll see the same pattern of a sharp rise in US bond yields. And as I walk around the world, I see we're now looking at Europe. I see a sharp rise in European bond yields from about 2% to 2.24. It's not quite as big. And if I go to Japan, we're seeing also a rise in yields from 0.81 to 0.963. But as a percentage increase, that's quite large, although it's not in nominal terms. And of course, the UK, which is here, you can see the rate has risen from 3.7 to 4.2, another half. That's another 0.5% up at a time when the UK government, the Bank of England, is cutting the interest rates. So we're in a funny world where, well, I suppose it's a normalization of world where the yield curve is starting to turn sharply positive. What's this telling us? It's telling us that the bond investors see inflation coming and they want to get up, or they'll only buy bonds if they're rewarded correctly, which means a higher rate of interest. So obviously, if you're getting a 2.5% or 3% in interest, that's not going to be enough if inflation is knocking around 4.5% or 5%.
I
So that's my message for you today. I think inflation is now starting to. We've seen the bottom in inflation. I think it's going to come back, and it'll probably come back with a vengeance next year.
I see you've got a little gold bar there. Is that like a hint?
Well, yeah, I did a little exercise the other day, Mario, which was how many, here we are, how many kilograms of gold do you need to buy? Oh, sorry, how many kilograms of £5 notes do you need to buy a kilogram of gold? So in 1970, you only needed zero point 0.1 kilograms of £5 notes to buy a kilogram of gold. By 75, you needed nearly half a kilogram of banknotes. By 2005 or 1990, you needed 1.4. 2005, you need 1.6 kilograms. 2015, you needed 5 kilograms of £5 notes to buy a kilogram of gold. And today, 2024, you need 12.8 kilograms of £5 notes if you want to buy a 1 kilogram bar of gold. So what's this telling us? That your kilogram bar of gold is buying you more and more £5 notes. And here I have a picture of a shop where you can change your cash with a pile. That's about 12.5 kilograms of £5 notes that you see there. And the man's he's wearing a burglar's shirt. The sort of message here is perhaps you've got to watch out because it won't be long before he dumps the money in the street and steals your wheelbarrow.
Yeah, and well, reminds me of Weimar Germany, where they had to carry cash in wheelbarrows. Of course, now we can do it electronically, and that's maybe one of the reasons why people don't notice that their currency is being debased so much. And it's interesting there in 1970, zero point 0.1 of a kilogram, that's only 100 grams. And Rudy here, he weighs about 6.8 kilos. So yeah, that's how much you need two Rudies in weight of 5 pound notes to get a kilo of gold. And I think it's going to get worse. You're going to maybe in a couple of years' time, you're going to need 20 kilos, Clive. And
Yeah,
so
that's
how,
if we still have the £5 note, of course.
yeah, that's true. So could we move on to, and I wanted to share something you sent me.
Sure, I'll stop that then.
So,
Yeah,
because there's been a lot of frustration, of course, people investing in the miners, but you sent me something that's really interesting that shows me that the tide seems to be shifting slowly but surely in favor of precious metals and the miners relative to the stock market, and that's what happened in the 70s in terms of asset allocation. And I think we're still really early, aren't we? In that a lot of the fund managers, pension funds, it's not even registering for them.
well, last time we had a bull market in gold, which was from 2000 to 2011, gold went up 350, 400%, something like that. We're only up about 20 or 30% in gold terms at the moment. So the bull market has just started. We're right at the beginning of a 10-year bull market, perhaps could be much longer than that. So I think there's a long way for the gold price to go. And of course, when you look at do you want to bring up that chart, or shall I do that,
Which one?
Mario? The one of which shows that the gold mining stocks are now starting to outperform gold, and gold
Yeah,
is starting to
I think
outperform.
I brought that up. It's this
Oh,
one.
you've got it. Oh, yes. Sorry, as you have it, it's popped up on the screen behind me. Um, so where we are now, Mario, is that the gold mining stocks money is starting to come out of the stock market a little bit, and it doesn't take a lot to move the gold mining sector because it's a very, very, very small sector compared with, say, any one of the Mag 7. But a little bit of money is trickling into the gold mining sector, and that sector, for the first time in many, many years, is starting to outperform the gold price itself, and the gold price itself is outperforming the S&P 500, as you can see on the chart since about February or March this year.
Yeah, and the talking about inflation waves we spoke earlier, I wanted to also show the viewers this. This is from Tavi Costa, and this was a post from December 2022, and he thought we were here, and that inflation, and by inflation, I mean the CPI. I know that a lot of times I talk about inflation being the increase in the supply of money and credit, but let's go with the what people use. But he was right that it was going to come down. I think in the US, CPI got up to 9%. In Europe, it got up above 10, and we have come down. But I think now from what you tell me, you feel that we're right here in the beginning. That so we could have in the next couple of years a massive wave of inflation, and then
Well,
it looks like inflation comes in waves or the CPI.
yeah. Mary, I know a lot of your viewers are based in the UK. So I just had a quick look at the public sector pay deals, which are being agreed across the board. We've got the teachers 6% backdated to 2023, I think. We've got the NHS staff at 5.5%. We've got the police and prison officers up 7%, backdated to September 23. We've got the armed forces pay rises of 6%. We've got the civil service pay rises of 5%. And in the public sector, where you're salaried by a commercial enterprise, the pay rises are averaging 6% at the moment. Train divers are getting 4.5%. Well, that's for next year. They're getting backdated 5% from 2022. So what we have in the UK is across the board inflation or non-inflation, right? Pay rises for people connected with government and private sector, which are exceeding the official rate of inflation. So what is the rate of inflation? I think these kind of pay rises, which are coming in well ahead of the official rate of inflation, tell us where the real inflation rate lies. And so if you're earning 3 or 4% or 5% on your bank deposit, you are not being compensated for the loss of buying power at all. And especially after you pay tax on it, you're going backwards much faster.
Well, I can tell you that my bank, NatWest, they even when prior to the Bank of England cutting rates, and I think they've only cut it once, the savings rate that I have is like below 2%. So it's never going above 2%. If you want to put it for 4 or 5%, you got to tie your money in. So yeah, they're really not giving savers much. So it looks like inflation comes in waves and that we could be right here. And we could expect more and more inflation to come. And I was talking earlier as well about money supply because that's how I see inflation. It's the increase in the supply of money and credit. And yes, when they started raising rates, the global money supply came down and prices stabilized. They're still going up, but look at it. Look at global money supply. It's now picking up, Clive, and that's concerning. I would say. And I read as well yesterday a post on Twitter that the mortgage providers in the UK they're already starting to pool deals that they had come out with about a month or two ago. It looks like the honeymoon is over for the UK government, and I think their black hole is going to get a lot bigger because, yeah, a lot of the UK, I think about two-thirds, more than two-thirds of the UK debt is over 7 years. So I don't you expect the longer end, the to go a lot higher than the shorter end?
We're, we're certainly going to run into indigestion as far as investors are concerned. Um, I'm talking now mainly about the USA, where I've got a much better grasp of the figures, but the level of US debt is rising very fast. There is no plan at the moment to cut the spending or increase the taxes, which means the deficit is going to get larger and larger. And one of the factors which hurts in that area is the level of interest the government has to pay on the money it's borrowed. That particular number is rising very rapidly because they've had a decade where they could borrow at rates of 1.5% or 2%, or even less, in fact, at certain points. But now they're having to pay, as we just saw, the 10-year, they're having to pay over 4%. So it's costing them many times as much to refinance their maturing debt. And the interest on that new debt that they're taking out is quite high. So that's causing the level of debt itself to rise quite fast. So it looks like we're at a point where potentially, unless something is done, we're going to spiral out of control. And it's not just me saying this. Some of the most important figures in the United States, such as Jerome Powell, has said it's completely unsustainable, and somebody has to do something about it. But of course, it's not Jerome Powell to do anything about it. It's up to the government. But I don't think the government's minded, especially not at the moment, just before the election, to do anything about raising taxes or cutting spending. But we'll see if that does happen afterwards. But I have my doubts.
Yeah, and so it seems to me that a lot of people in the markets are expecting a rate cutting cycle just because they started cutting rates back on the 18th of September. And you look at the Fed funds rate historically, once they cut, they keep cutting. But to me, it seems like with what's coming up, it will be difficult for them to cut. And that would be quite unprecedented that they couldn't continue cutting. And the next FOMC meeting is just after November 5th, which is election day. So they meet on the 6th and the 7th. So do you see them cutting again, or might they have to halt cutting, especially if we continue to see bond yields rising? And do you think Treasury yields and European government bond yields, UK yields are rising partly because of the China stimulus situation? Maybe we could switch over to that a little bit and get your take on that.
The China stimulus is, at this point in time, nothing more than a promise. They've said it will take time because for most of the measures, there are legal implications which have to be worked through. So what we can say at the moment, it's words and not actual money being thrown into the market. I mean, I suppose there are areas where they could immediately throw money. I mean, one of the stimuluses they're talking about is a stimulus for the Chinese stock market, where they're going to throw in 800 billion yen. And I don't know if they've started buying or not, but the market rejoiced at that news. Maybe I'll just bring up a chart of the China 50 stock exchange to show your viewers what happened. It was quite crazy. Share. So what you're looking at there is the Chinese 50 index, which rose by in a week or two, a couple of weeks. It rose by 47.9% from the low point to the high point, the low point being mid-September, the high point being effectively a few days ago. And it then dropped by 20%. So if you can imagine, a lot of Chinese investors went absolutely crazy, buying and selling things. And there will be some who, sad for them, they probably bought at the top, and now they're looking at a 20% loss. Now, imagine that we had this type of volatility in the European or American stock markets. We did once get it way back in 1987 when stocks dropped by 30% in a single day. But it's been a long, long time since we've had that sort of one-day crash. But, one has to be aware, if you're in stocks, they can be extremely volatile in both directions. And those who were buying Chinese stocks before this rise are sitting very pretty. I mean, I happen to be rather pleased with myself because I did say, I don't know if it was on your program, but I did say a few months ago that the place to buy stocks is in the most unloved place where nobody wants to go. And I bought an ETF. It's a Chinese consumer durables ETF. That's up 40%, that ETF. So, when you want the time to buy things is when nobody else wants them, and not when you're. And then, of course, you have to wait for some trigger event to cause it to rise. But what's going on with China? Well, obviously, this money is going to come into the market. They're going to stimulate the housing market. They've set aside a lot of money for that. Um, they're going to. I'm just having a look at their measures here. The stimulus package is 7.5 trillion yuan. That's 1 trillion US dollars equivalent. They're going to allow the banks to have less reserves, so that's to encourage the banks to lend money to people. They're going to help people with their mortgages. They're putting 2.5 trillion yuan towards helping people with their mortgage repayments. I don't know how you qualify for that. They're going to give money to the local governments so that they can spend it on local government projects, which will stimulate the economy. They've got 1 trillion set aside to bail out the banks here. And then they've got 800 billion yuan to prop up the stock market.
Yeah,
So all of that's money coming into the market. I don't see why that would cause interest rates to rise anywhere, because you'd think if there's money coming to the market, it'd be actually money to spend somewhere.
yeah, but I would say maybe a lot of Western money might sell bonds and go into China, but who knows?
Yeah, it could be that. I
It could
mean,
cause also, Clive, it could cause commodity prices to rise, and that
that's
could
right.
put pressure on the CPI. And the interesting thing about the Chinese is that we know this property problem they have, real estate. This has been happening for the last, well, over 2, 3 years, isn't it? And they've waited quite a while to come out with stimulus. Here in the West, we seem to react straight away. And maybe, do you think, and I'm not trying to say they know what they're doing, because I don't think governments interfering work that well in the long term, but do you think the Chinese authorities and economists there thought we need to let the froth unwind? We need to see liquidation, so that's why they waited so long to come out with the stimulus?
I think it's very difficult to know what's going on there, but I think the reality is it's a very autocratic society from the top down, and you need the man at the top to give his nod of approval. It's not like you've got departments who could decide what to do all by themselves. And so I think at the end of the day, the cries for help had to get bigger and bigger until he couldn't not hear them. And so the point came when he said, go for it. And so all the departments would have had their recommendations. And, at some point he says, okay, we can't hold back the tide any longer. We might have a revolution on our hands. Let's, I mean, I'm not saying that's a likely thing, but, let's do something before it does get out of hand. So, yes, I think it was probably inability to make a decision until the man at the top had said, I authorize you to make that decision.
Yeah. So, Clive, just want to bring up some charts here. I think it was about a week ago, a little longer. I spoke about Japan because the new prime minister there said that, and also the central bank governor, they met and they said that the tightening of interest rates would stop right now. And I said at the time, and I drew this chart, that I expected the price of gold to go towards 400,000. And it has, because the yen has weakened. The dollar's almost gone back up to 150, I think. So here we are making new highs in the price of yen, in the price of gold in yen. And I wanted to bring up the UK as well. We're making new highs.
Well
Uh,
over 2000 now.
yeah, 2022. And in Swiss francs as well,
Uh,
2,265.
and if you look at Australia, you'll see that we're about to break through the $4,000 level for the first time. It's about 3,920 or something like that.
I will bring
It's
that up. I just wanted to show you the euro as well. That's so this is,
breaking an all-time high.
yeah, this
Mhm.
is not about a dollar weakness, dollar strength. This is just about fiat currency weakness, I would say. And that's why I've always said that, yeah, keep your eye on the gold price, not on the dollar. Let me try. Can I? I think I have to here, bring up the Aussie. Yeah, 3,923 Aussie dollar.
So my bet is within a couple of weeks, if not days,
Yeah.
but probably weeks, we'll see the Australian gold price break another barrier, and the barrier I bet this time being $4,000.
Let's look at the dollar price because I think we could see I ignored this part six and stuff. This is something else I was doing. I can see the dollar price of gold be at 2,800 before the end of this month, actually, to be honest. So it's all looking pretty good. And have you been buying some gold and silver lately, Clive?
Yeah, yes, indeed. In fact, three times this week, I went to the shops. The first time they had the silver Australian lunar collection snake for 2025. It's a new coin which has just come out. They had that in silver. I went to get that, and then a few days later they had the gold one, the Australian lunar 2025. It's the snake, a very beautiful coin. Both the silver and gold coins are very beautiful. You have to pay a premium over the gold price because it costs a lot of money to distribute them, and there's quite a limited supply. So when I went to the shop, they only had about 9 left of them out of maybe a collection of 20 they'd got to start with, and they'd only had them for about a day or two, so they go very quickly. I also managed to get there's a new Spanish coin just come out in September. It's the eagle. It's the fourth one in the collection of Spanish animals. They've got the dog, the horse. I think Caballo is the horse, and one other. So this one's the eagle. It's the 2024 eagle. Don't know why it came out only in September, but that's in gold. And that one also is a very beautiful coin because it comes in a lovely black case. So I think, if you want to get some beautiful coins, those are the ones to go for. But if all you're buying is bullion for the sake of making a profit down the line, then you want to be buying the bigger bars, the 1 kilogram bars, or potentially buying an ETF.
Yeah, I personally wouldn't touch ETFs, but that's people's choices. I just wanted to show here Miles Franklin, if people are interested. They are my affiliate in the US, and you can find details of how to get in touch with them in the description. So right now they have a special on 1 ounce gold Canadian maple leaf coin, 60 over spot. That sounds a lot, but it's less than 3% with where the price is. And 1 ounce silver Australia kangaroo coin, three almost $3 over spot. And here in the UK, for my UK viewers, let me show gold investments. All the details are below in the description as well. And here in the UK, I recommend that people buy coins of the realm because they're capital gains tax free. And I think the UK coins are quite beautiful anyway. So you don't, yeah, like I've got this one here actually. This is a new St. George and the Dragon 1 ounce coin. Actually, when I bought it, Clive, over a month ago, I paid less than 2,000. So it's already costing 2,098. And yeah, check the description of the video and try to do like Clive does. He buys once, regularly, your dollar cost average. And why do you buy it, Clive? Can you tell the viewers
Yeah.
why
Well,
you buy gold? I mean, it's pretty much the same reason that I do, but I want to hear it from you.
I've been a gold investor since my grandfather gave me a coin right in the early 70s. It was a gold sovereign, a £1 coin, worth about £3 or £4, perhaps, when he gave it to me, now worth £450. He asked me to keep it forever. But when I first went to get it valued in 1975, I went to Sharps Pixley in London, and they told me that, I can't remember the figures now, but it was certainly a price I didn't like. They said they'd give me 10 or £20 for it, but they'd sell me another one for 25 or £30. And I certainly didn't like that price. But thinking about it, I then went back to them and bought myself a Krugerrand, and ever since the 1970s, every now and then I pop into the shop and buy some. Uh, whether it be in the old days, it used to be Krugerrands, but these days you have a much bigger choice. But what's interesting these days is you could buy coins which are part of a collection. So not only are you getting a participation in the gold price, but you've got something to show off to your friends and say, look at this beautiful coin I bought. And like the collections I love are in the UK, you've got the UK Beasts. They're really beautiful. In Australia, you've got the Lunar collection. Those are really beautiful. And I've just started collecting the Spanish collection. I've got all four of them. I think I don't know what they're called, but I call them animals. But they've got pictures of things like eagles and so forth. And each year they bring out a new coin with a new design. And the fun thing is to get the latest version, then see if you can find at a reasonable price the rest of the collection. So in some of the areas I've got the entire collection, and some of the areas I'm still looking for the missing pieces, and that's a lot of fun, a lot of fun. But the good news is you're holding something in your hand which is never going to go to zero. It will always carry as a minimum the gold price, and if it's a coin which is a certain rarity like the ones I've just described, then that premium will continue to exist because as time carries on, there'll be less and less of them available as they've come into people's long-term collections, and therefore new collectors who are starting to collect this collection and want to fill the gaps in their collection will have to really pay up to get them if you want to sell it. So in general, when you sell a collector coin, you can probably recuperate a lot of your premium, provided you don't sell it to someone who's going to melt it down. So if you take it back to a pawn shop where all they're interested in is the value of the gold, they'll say, "We'll give you the gold price for it," and that's it, and they're going to melt it down. But if you advertise it in the right way, for example, you go to a coin fair or a swap meet or in some event where it can be sold or in one of the online auction places, then you should usually recuperate not only the value of the coin, but also the premium you paid and maybe a bit more if some years have passed.
The the reason why I think gold and silver are a good place to be, and yeah, you can start out buying the bullion, and then if you get used to it, do what Clive does. You always have to start somewhere, do collecting. The other reason is because it's very hard to mine gold and silver, and it takes a lot of work and effort to mint the coins. While our fiat currencies, they're just created out of thin air. They don't even put it on paper anymore, Clive. It's all electronic. So yeah, the trend is unfortunately not good for the currencies. And with that, Clive, maybe you can tell the viewers where they can find you as we wrap up here.
So anybody who's got a question, I'm very happy to try and answer it as best I can. I don't give investment advice, but if you have some thoughts about investments, I'm very happy to tell you if I think you're on the right track and help you have some clarity around your thoughts. LinkedIn is the only way to contact me. So if you're on LinkedIn, you can contact me that way. I know a few people have actually joined LinkedIn just so they can send me questions, and I'm quite happy with that. And yeah. I'll do my best to answer. Sorry, I don't necessarily get to every single question, but I do answer several a day at least.
And yeah, it's Clive Thompson on LinkedIn. And yeah, I wanted to wish you all a very good weekend, and you as well,
Thank
Clive.
you, Mario, and have a lovely evening. A lovely day.
Yeah, no problem.
Yeah, a great weekend.
Thanks.
And thumbs up to you, your viewers.